The great reversal has officially begun, and no, this is not a drill. The Federal Reserve has just pumped the brakes on its quantitative tightening. And while they didn't make a big deal out of it, make no mistake, this is a major shift.
So we did it. It has no implications at all for monetary policy.
Because when central banks start backing away from balance sheet reduction, it's not because things are going smoothly. Now, some will say it's about the debt ceiling. Others will say it's a sure signal of an incoming crisis. But the truth is, what's happening right now beneath the financial surface is far more dangerous than most people even realize. The Treasury market, the foundation of the entire global economy, is being held together by hedge funds. Hedge funds running highly leveraged trades. And if those trades go south, the fallout will be massive. So what exactly did the Fed just do? Why does it matter so much more than they're letting on? And most importantly, what does this mean for the future of the dollar, your wallet, and how can you protect yourself before it's too late? Let's get into it. Since the 2008 Great Financial Crisis, the Fed's large-scale purchases of treasuries have played a huge role in monetary policy, impacting almost every facet of the economy. This process, better known as quantitative easing, or as most call it, money printing, works like this. The Fed buys US debt like treasuries or mortgage-backed securities, but they don't use real or existing funds to do it. They create a credit, essentially issuing currency out of thin air. They're creating money out of nothing that then gets pushed out into the financial system, stimulating the economy and propping everything up. But in reality, this is what's also fueled asset bubbles, rapid inflation, and of course made the already wealthy wealthier by pumping trillions into Wall Street. But the Fed knows this, which is why in its fight against inflation, they have been reducing their holdings, letting these treasuries mature and roll off their balance sheet, a tightening, if you want to call it, essentially a way of pulling liquidity out of the system. But now they're pulling the brake, slowing their tightening by 80%. But why would they do that? Why would they slow the tightening when inflation is still well above the 2% target? The government continues to spend at a reckless pace, and they're nowhere near able to cut rates despite tremendous pressure to do so. Could it be that they're scared, and maybe we should be too? But that's not all. There's another layer to this crisis, one that hardly anyone is watching and very few are talking about: hedge funds. Hedge funds are providing tremendous liquidity right now to the treasury market, but here's the problem. They are thinly capitalized and highly over-leveraged. In simple terms, they're borrowing massive sums to exploit minor price differences to get a modest return, but they're doing it using extreme leverage. And the scale is staggering. Estimates now suggest that hedge funds make up 11% of the treasury market, with these high-risk, high-leverage trades representing over $1 trillion worth of exposure. But think about what that means. A significant part of the supposedly safest market in the world is propped up by borrowed funds, where even the tiniest disruption or volatility could create a catastrophic event. But in fact, we've already seen how this plays out. In 2019, the Fed's tightening policies, followed by COVID, led to a liquidity crisis in the repo markets, where rates shot up overnight to unprecedented levels, and the hedge funds who were involved in these trades, well, they were toast. They lost their shirts. In fact, the situation was so dire that the Fed was forced to step in and intervene to the tune of $100 billion plus monthly quantitative easing. Now, too big to fail 2.0, a bank bailout by another name, just a financial institution? I think so. They denied it. At the time, they said they didn't need to do it. But today, many have admitted that without that intervention, the financial system as we know it would have collapsed. Now, if you're wondering, how have I never heard of this? You're not alone. It happened in 2020, and most of it was just swept under the rug as another news day during COVID. But the hedge funds were never punished. They were allowed to continue doing this, and it's happening again. In fact, just this past week, experts have come out ringing the alarm bell, saying that the Federal Reserve needs to make sure that they have a bailout mechanism. an emergency facility to help these hedge funds unwind their trades during a crisis. Unwind their trades. Don't you love that verbiage? Don't be fooled by it. It's a soft-sounding word. Blow up would be a better word. When these trades go upside down, the Fed has to be there ready to step in and bail them out again. Now, this tells us two things. First, they know a crisis is coming. And second, they are preparing for it. They are willing to do whatever it takes to stave off disaster, despite the hedge funds being the ones knowingly taking all this risk, and you and I being the ones left holding the bag. Who's really in control here? The implications of this are huge. If the Fed is willing to stave off disaster and help these hedge funds in this way, it just goes to show how vulnerable the entire system is, how there really isn't a foundation anymore. We have hollowed it all out. But for you and I, for everyday Americans, it means increased volatility. It means retirement savings could be at risk, more economic uncertainty, bad news all the way around. So let me ask you this. If the Fed is quietly slowing their quantitative tightening to avoid a cascade in the Treasury market, and they are preparing for a bailout-style backdrop, well, what does that tell us about the state of the US dollar? Because if the only thing holding up the most important bond market in the world that the dollar depends on is borrowed money and a hope that the Fed will catch the fall, that's not stability. That's insanity, and a house of cards that is one whiff away from collapsing. The Fed is concerned, the Treasury's out of cash, the bond market is propped up by hedge funds who are over-leveraged, and inflation is not under control. But the worst part is the rest of the world is watching. You better believe that countries like China, Russia, and BRICS nations are taking notes. Why would they ever want to hold on to US foreign exchange reserves or US dollars? It makes no sense when they see everything that's going on, which is exactly why they are moving into gold, into commodities, working on bilateral trade agreements in local currencies. There is a global shift away from the dollar-denominated system that has only continued to accelerate and gain momentum. And what is going on today in the United States is not de-accelerating that shift. This is the quiet phase of the global reset. It's already in motion. But for the average person, this means higher inflation, higher rates, more economic uncertainty, less purchasing power for every American out there who is holding on to savings, retirement, 401ks, anything that is dollar denominated. You are at risk of losing significant value as time goes on because the dollar is going to continue to decline in value. The system is not going to fix itself. We might be able to keep up the charade a little bit longer, continue to play kick the can down the road, but it cannot go on forever. Trust in the system, trust in the currency is broken, which is why all of these central banks, smart money, those in positions of power and knowledge are already moving or have moved into gold. But this is why I keep saying gold is not just an investment. It's not a trade. It is your insurance policy. It is your way of making sure that your wealth is protected outside of this system. Outside of this system, we know was not designed with you or I in mind. People love to ask me, when will I know when it's time to get out of the current system? And my answer to that is, if you know that this is happening, if you know that this is unsustainable, why are you waiting? Why are you trying to time the system when you could be sleeping peacefully at night knowing that your wealth is protected? Now, if you are concerned about any of this, you want a second opinion on the strategy you have in place, or you are new to gold and silver and you want to learn how you can protect yourself, I highly recommend that you download our free gold and silver guide. That's why we've created it. It is a terrific resource for everyone, no matter what level you're at. It has a ton of great information in it. You can download it by scanning the QR code. You can click the link in the description below. And if you'd like to get even more information, you can talk to one of our expert analysts who have years of experience in gold and silver and currency resets and all of the things I talked about in this video. They are the best in understanding how to protect your wealth. So any questions you have, talk to one of our expert analysts. You can call us directly at the number below or pick a time that works best for you. Click the link in the description below and you can set up a Calendly appointment or scan the QR code and set up a time that works best for you. And in the meantime, I so appreciate you being here. I'm Taylor Kenny with ITM Trading, your trusted source for all things gold, silver, and lifelong wealth protection. Until next time.